Hi class, welcome to this video which is going to introduce us to the concept of budgeting, which is in chapter 20 of your textbook. Now, something to flag that we will discuss now essentially, this is the major part of the study design in 2020 that has changed. So we will be discussing how it has changed, but how we can still use this concept of budgeting to understand why it's important and ultimately do some really important analysis. So how has the study design changed? Ultimately, because of the coronavirus, we have changed this part of the study design. And it's important to look at the study design to think about what we're talking about. Students are now no longer going to be required to prepare budgets. You can see the word has been crossed out. We're now required to use them and analyze them. So what does that mean? Pause if you want to have a look at this. We're no longer going to get you to make budgets, but you do need to know what a budget is to use it and analyze it, because you can't use something unless you ultimately understand what it is and what the purpose of it is. You can't use, for example, a kitchen blender. You don't have to build one now, but to use it, you need to know what its purpose is and how to use it effectively. Hopefully that analogy makes sense. So what do you think this means? I should have put this up earlier. That's what we're talking about. So what is our learning intention today in this video? I hope that you leave this understanding the importance of budgeting in a business and how we can use this to analyze and make businesses better. Ultimately, that's what accounting is, giving advice and improving businesses. Our success criteria by the end of this outcome is, I hope you can explain the need for budgeting and the process. You can outline the role of budgets, and you can identify the different types of budgets. There are 3. And ultimately, then we'll spend most of this time analyzing budgeted financial information so we can identify issues, opportunities, and give strategies to improve the business. Ultimately, the second, the third, and fourth success criteria are the ones that are really, really important to this amended study design. Analyzing the information, identifying issues, opportunities, and giving strategies to improve the business. So what is budgeting? The owner of a business to be able, we do budgeting to allow the owner of a business to be able to do 3 things: plan, control, and make good decisions. So budgeting allows the owner of the business to be able to plan and control its business activities to ensure good decision making. So any word question about budget, really try and hone in on those 3 words. Budgeting is the process whereby management tries to predict its future financial transactions. So key word here being predict is important. These are predictions. And as we've said, budgeting has 3 major objectives. Budgets help management, there's that key word again, plan the future of a business. A financial plan should be in place so the management can see where the business is heading in terms of its performance, and budgets are a key part of that. A budget should also help control the future expenses of a business. If expenses are controlled within certain limits, we have a chance of meeting our plan and being successful. Unless we have a plan, we can't control something. And by doing this, the budget should allow for good decision making. It can reveal future problems, and then they might not be problems because plans can be modified and revised to address the problem. I would like to know 2 months in advance that I'm going to make a loss, because then I can put in make lots of good, remember the key word, decisions to make sure I don't make a loss. And that's budgeting. So what's the key bit? Budgets are predictions, not actual reports. So budgeting is the process of preparing reports that, keyword here, estimate or predict the financial consequences. We're talking about predictions. what happens with predictions, they might not be the same as what actually happens, and we'll come to that in a future video on variance reports. So there is really a process here that a business will take. From the top one, budgeted reports are prepared, predicting what is likely to occur. After some time, the time has happened, so actual reports are prepared. So we might make a budget for our September profit numbers, and then September ends and we can make our actual report on profit. We will compare them via a variance report, and then we can make decisions on how to improve it going forward. So key things to remember: budgets report future events rather than historical events. What will happen rather than what has already happened. Budget use estimates or predictions rather than actual verifiable data. And there are many types of budgets. You can see them in page 392 to 393 of your textbook, but ultimately there are three that we care about. The budgeted cash flow statement, which estimates inflows and outflows of cash and an estimated cash balance. Budgeted income statement, which predicts revenue expected to be earned and expenses expected to be incurred, and ultimately net profit. And budgeted balance sheet, which predicts the future financial position of a business. This includes assets, liabilities, and owner's equity. So if we stop there, if we make these three reports, we know a lot of information. We know the cash inflows and cash outflows, an estimated cash balance. We know the predicted revenue and expenses, and whether we're going to make a net profit or net loss. And we know the predicted balance of our assets, liabilities, and owner's equity. And that really is more than enough information to make good decisions to plan and control our business. And that's why these are the three we focus on. And this allows us to then do some analysis, and with these terms we'll become experts later: liquidity, profitability, liquidity, gearing, and efficiency. There are four key words here that I really want you to understand, because we're going to use them when analysing budgets later. These are the four key terms to remember during the analysis. These are the four key terms to understand and use in your analysis. Liquidity is whether the business has the ability to meet its short-term debts as they fall due. How do we pay our short-term debts? We must pay them in cash. So do we have enough cash to pay our short-term debts? Profitability, probably relatively simple. Does the business have the ability to make profit, but we're going to compare it against a base such as sales, assets, or owner's equity? What is the profitability of our business considering how much sales or assets or equity we have? Stability or gearing looks at debts again, but it is the ability of the business to meet its debts and continue its operations in the long term. So liquidity, short-term debts, stability or gearing: are we stable enough to be able to meet all our debts ongoing? Do we have too much debt in our business? And finally, how efficient are we? Do we have an ability to manage the use of our assets and liabilities? Can we use our assets and liabilities to earn revenue with little waste? So if you see these key words, you know what to talk about and what to focus on. And when we do some analysis later, these are some of the keywords that we will talk about. And in future chapters, you'll get more and more tools to discuss these terms. So what are the types of financial budgets? The cash flow statement looks like this. Pause your video and have a look at it. Our income statement budget looks like this. And ultimately, our balance sheet looks like this. So thinking about these, our income statement and cash flow statement, and our balance sheet, what do you notice? What I hope that you noticed was ultimately the only difference between this budgeted balance sheet and an actual balance sheet in the way it is looked and designed is one word. We write budget. So the only difference is these are predicted numbers, not actual numbers. The format is the same. So it is great revision. And that's what we're going to be using to think about. So the budgeted cash flow statement gives us lots of information. It gives us estimates of cash inflows and outflows. And this will tell us, do we have a cash surplus or a cash shortage? And this allows us to make decisions. If we have a cash surplus, we have lots of cash. We have a prediction that we're going to make more cash than in our inflows than outflows in that period. This allows us to make some decisions if this is what we think is going to happen. Should we save that money, or the management may plan to do some other things? They might use the funds to retire debt, to pay off debt. They could replace old assets with new. They could expand the inventory that they're selling to try and make more sales. Or they could decide the best way to do this is take some money as a personal drawing. But if we predict a cash surplus, we can use that information to make decisions. So if you see a cash flow statement budget that has a big cash surplus, these are some of the things that you could do, or you could just decide we're going to be safe and keep it as cash. If we have a cash shortage, this is a potential issue. And this is where the budget is more powerful because we can start to make some decisions before it actually happens, maybe even fix this so we don't have this cash shortage. How do we fix it? We might make an additional capital contribution. We might cut back on drawings, arrange finance, so get a loan. We could lease assets rather than buy them, or we could reduce or delay the payment of expenses. But knowing this prediction in advance allows us to make decisions. So let's try and do this. In this question, in a normal study design, we would have been asked to make a cash flow statement using this information. We don't have to do that, but we do have to analyze it. So using this information, I can create a cash flow statement that would look like this. Pause it and have a look at it. Is this a good or bad outcome as a budget for Hepburn Springs Hardware? And now let's do some analysis. I'm going to use some terms that you might not have heard before, but this is where we ultimately hope to get in a couple of weeks. I want you to think about this beforehand. Sorry, I've jumped around a little bit. I want you to do some analysis. What are you noticing? Does the business have good liquidity? Does it have enough cash to pay its debts? Should we be concerned? And what are your recommendations to this business? Let's do this though. If you look at this, you can see the business has a budgeted cash surplus for the quarter ending 31 December. It has budgeted a net increase each month. It has more cash coming in than out. This may indicate the business has good liquidity. It is able to pay its short-term debts as they fall due with all this extra cash. So we're not too worried. So what has created this cash surplus? We've got increased cash sales. Each month, our sales have gone up. That's a good thing. Not only that, we're getting more cash from our accounts receivable paying us back. And the only time that we've done a really significant one-off cash flow coming out was when we bought a computer in October. Why might we be concerned though? We are, and this might make sense, making more and more payments in cash to our accounts payable. That might make sense if we're selling more, but let's consider it. We are paying an increased amount of advertising in December. Is this okay? Why am I doing this? And should I be concerned that the business owner is taking out $2,400 each month? These are the things to consider and do some analysis. The budgeted income statement follows the same format as our traditional income statement, and hence it shows us profit. The only difference is the data again is estimates rather than actual. But the end result is a predicted profit or loss. So this is going to be looked at, and we're going to then try and look at it to how can we, if we have a predicted profit, or maybe if things are bad, have a predicted loss, how can we do something to increase our revenue or reduce expenses to increase our profit or maybe even save the business from a loss? So if we look at this one, Smart Screen, it has an estimated net profit of $2,849. Is this good or bad? Are we happy or not? This is up for analysis. But because of this, we can make some decisions. We can make some decisions in response to this budget. If we need to increase revenue, if our budget says it's really important to increase revenue, we can then make some decisions. How can we increase our sales? Do we have to do an advertising blitz? Do we have to make some promotions? Should we increase the markup? So sell our goods for more to make more profit per good. Should we eliminate slow-moving inventory items? What are the ones that are selling slowly and we're not making much revenue off? And do we have to update our inventory because of changing trends? All of these things could increase revenue. They all have risks associated, but having a budget helps us make that decision. If we need to reduce expenses, so our budget says our expenses are too high, we can use information from the budget to make good decisions. Do we need to decrease the hours of our staff to reduce wages? Do we need to review our suppliers and get our inventory cheaper, or maybe try and get a discount off them? And can we review and make some savings on all of our regular expenses like electricity, telephone, insurance, rent, all of those things? And the budgeted balance sheet is the final one, and we're asking, what is the performance of our balance sheet? How stable is it? What is the expected result of our assets? Are our assets being efficient? We should be looking at this to evaluate a term that we haven't heard before, the future working capital of our business, which is about our current assets and current liabilities. We will become an expert at that in future chapters. And we can think about the financial structure. Do we have too much debt? So this is all about our liquidity and our gearing and stability, because gearing and stability is all about our long-term liabilities. So let's think about and do some information. Let's analyze a complicated one, question 20.10, high point hi-fi systems. We're asked to use this information, so pause the video and have a look at it, and make not just one budgeted statement, a budgeted cash flow statement, a budgeted income statement, and a budgeted balance sheet, using all of this information. So we're probably pretty happy we don't have to. Our budgeted cash flow statement would look like this. Can you analyze it and try and identify, is it making good cash? Why? What should we be concerned about something? Do that analysis. But let's have a look at it. The business has a budgeted cash shortage. It's a different one. We are suggesting that we are going to lose $1,290 of cash in the month of July. This might indicate that the business has cash. We may not be able to pay our debts. Are we concerned about that? So what has created this cash shortage? Why have we lost cash this time? The major one is that we $6,000 of cash went out of our business because of the van. We also potentially have drawings $2,000 has been withdrawn by our business owner when there is a shortage. And these big things have led to us not being able to cover this by our operating cash flow. The good news is we are making cash from our business, but there's been some one-offs. So what makes this cash flow statement positive, which might feel weird when we have a cash shortage? We have a really positive cash outflow. We have more sales and receipts from accounts receivable than our payments to our accounts payable. We're making cash. And a small but positive beginning balance, we had $2,000 at the start, suggests we might still be able to pay off our debts. And many of these big cash flow outflows probably are one-offs. The delivery van is probably a one-off. Maybe even the rent. That could be for a number of months. The advertising, we never know, could also be a one-off. So this is where we would have to start to consider it in conjunction with other budgets. And the good news is we do have other budgets. We have an income statement. And our income statement shows a different story. We have made profit of $2,330. So the business has a budgeted net profit for the quarter ending for the month ending 31 December. And this indicates that the business has pretty good profitability. It is making a profit. But we are going to have to become experts at comparing that to the base of total sales. So are we happy with making $2,330 of profit on $20,000 of sales? We're going to have to think about maybe, is this profit going up or down? A trend analysis. What is the industry average? What are our competitors doing? And to do this, we will use some things called return on investment and return on assets, which are in future chapters. So what has created this net profit? Again, some things we're going to learn about later. We have a really good gross profit margin. We make gross profit of $10,200 on sales of $20,400. That means we have a gross profit margin of 50%, and our net profit margin is 11.4. Are there areas for concern? Of course. Our rent seems pretty high, and our depreciation also seems pretty high. Are we concerned about this? Is this too high? Why are we paying $3,000 of rent to just make $20,000? And why is profit really different to cash? Remember, profit is accrual, cash is simply cash. So you can combine them to start to think about, is this business healthy? It's losing cash, but making a profit. So then we come to the final one, our budgeted balance sheet, to consider the efficiency and whether we have too much debt. The business has a budgeted net profit and negative cash for the month ending 31 July. There are some errors in this bit there. And this indicates that the business does have pretty good liquidity. Liquidity means we can pay back our debt. So this is a little bit wrong. It should be negative. But ultimately, our current assets minus current liabilities, do we have enough assets to pay our short-term debt? We have current assets of $39,000 and current liabilities of $25,000. We have more short-term assets than short-term liabilities. And we can use an analysis that we'll learn later, working capital ratio, to say that actually we have $1.53 of current assets to every $1 of current liabilities. So surely we can use these assets to pay off our debts. But is it actually a good news story? Can we sell our inventory really quickly when our debts come due? You could argue no, so maybe we only have quick asset ratio, assets that we can quickly turn into cash, we might only have 25 cents of assets we can quickly turn into cash, our cash and accounts receivable, for every $1 of current liabilities, which when they're due, we will have to pay them back. And are there areas for concern? Do we have too much debt in general? Our gearing ratio is 41%. This would be considered mediumly geared. We're not too concerned about, and again, I am conscious I'm talking about a lot of things that we haven't been exposed to yet. This is what we're going to be doing in the next couple of weeks. So that is how we analyze budgets. We're going to keep building your toolkit up with these techniques over the next couple of weeks, and then you will look at budgets, look at information, and ultimately analyze this information to identify issues, identify opportunities, and come up with strategies to improve businesses. This is the exciting part of accounting. It's how we make the big bucks as accountants, and it's how we are sometimes the most powerful person in the room. Now's the time to practice this analysis to become an expert.